Hello and welcome to today's yet another new episode. And today I'm going to speak a little bit on agrochemical sector. This sector has been underperforming for quite some time, right? So the question remains, how would be FY26? Is there any hope of recovery? How the sector is panning out at this point in time when the IMD's forecast for this particular year is again very good. Last year, IMD's forecast was good, and finally, we had a very beautiful monsoon. This year, even it is predicted higher than last year, that is 105% of the long period average is expected monsoon for FY26. On that backdrop, how the underperforming agrochemical sector is going to pan out? This is the biggest question. So I will give you a few hint like how the sector is panning out with couple of companies, rather three companies. Let's take three companies. FY25 numbers are out. I've attended a few of the calls from the management after Q4 FY25. So how the thing is panning out, that has some sort of idea. Like it's getting gradually clear. So in this video, I'm going to share my understanding from this particular sector, how the sector is going to pan out. Before that, I have a disclaimer that I do not have any buy sell hold recommendation through this particular video. The stocks I'm going to mention is not at all any recommendation. If you have any interest for investment or trading in this particular, like in these mentioned stocks, then please check with your registered advisor or take the call by yourself. So without wasting time, let me start with the sector, theme of the sector, how the sector looks like, right? The question is, we all know that the last year, let's say last year, even before that, the problem was there. That was the inventory problem. Oversupply and inventory buildup in the sector impacted the overall performance. So how the inventory situation is currently in the system. So inventory has more or less cleared, and so the inventory is not likely to play the spoil sport. Domestically, volume growth has been observed in FY25, supported by early sowing activities and favorable monsoon forecast, what I have already discussed. Now, the biggest problem in this particular sector at this point in time, that is the pricing pressure. Pricing pressure is not only in the domestic market, it's rather severe in the export market, and companies who are export focused or contributing a certain segment portion of their revenue from the export market are getting impacted. So this price erosion is not new. Price erosion started long back. We have witnessed this price erosion thing since 2018 in the pharma sector. Afterwards, like it continued, started with US, globally spread. Afterwards, it continued and came to other chemical sectors as well. Agrochemical is also a hit. Now, with there are certain green shoots here and there, but finally recovery is still pending. I'm not saying only about agrochemical, it's all about the chemical space. Some niche, some scattered molecule may have performed, but overall, if you take, then it's a damn underperformer. Let me start with Rallis India. Around 75 to 78% revenue comes from the domestic market, and rest 20 22% comes from export market. That is Rallis India. Export played a significant role in this particular year. It was a dampener of overall performance. If you would like to understand Rallis India, then we have to understand about a few specific molecules which are playing the significant role in the export market. What are those molecules? Firstly, acifet, then hexaconazole, then metribuzin and pendimethalin. These are the four key molecules we have to understand. Its pricing is very important, and with uh, like when once the pricing of these products remains under pressure, then inter export revenue remains under pressure for Rallis India. They have CRAMS in their portfolio, one particular molecule that is PEKK. Uh, so that is a very important factor for their CRAMS business, although CRAMS is a possibility for Rallis, but CRAMS is not a big investment driver at this point in time. Apart from this pricing factor, I have said about monsoon and raw material cost and channel inventory also I have discussed. Now, raw material cost is very important because apparently it seems that once raw material cost goes down, then your uh, margin improves, but it's not the fact. Prices of the output is going down along with, or let's say in tandem with, the raw material prices. तो इसमें प्रॉब्लम कहाँ है? The problem is obviously your revenue is getting impacted. Registered good volume, but revenue has registered less than the volume growth just because of the pricing factor, which is where there is erosion. We will see this situation happened in UPL. So we will discuss on it. Apart from this situation, along with that, we have to understand little bit of the inventory situation, inventory days, receivable days, and net working capital days. These are also a few factors which we have to have a look over there. Okay, after the first company of Rallis India, quickly let's have a quick look into the UPL. And we know that UPL is very much export focused company. Rallis, I said, like around 75-78% comes from domestic India. In contrast, UPL is completely different. There only 13%, around 13% revenue comes from India, and rest 85-87% comes from the global market. And here in the global market, Latin America is very important. In FY25 contributed around 38% of the revenue. Now, in Latin America, again, Brazil and Argentina are the very important geography for the company. Europe also plays some significant role with around 15% of contribution. North America is also significant with 13% of contribution in parallel with India. We have seen recovery in UPL after quite some time. After quite a few years, UPL was underperforming due to one geography or the other. So continuously, some other geography kept on playing the spoil sport, and that's why UPL was underperforming for quite some time. But here is the time of recovery. In FY25, we have seen improvement in the receivable days, which is clearly visible in my page. Inventory days has improved from 108 days last year to 81 days in FY25. Trade receivable days has improved from 124 days to 102 days, helping net working capital to improve from 86 days to 51 days. Significant improvement is visible in the working capital cycle of UPL. UPL had total revenue growth of 8% in FY25. That is like on the higher end of the FY25 guidance. They almost made the guidance. So volume growth was 13%, but revenue growth was only 8%. So how this 5%, where this 5% has gone? We know that revenue is the product of volume and price. So price, there is a price reduction of 3%. Another 2% has been ate by exchange rate. exchange rate fluctuation. Channel destocking is believed to be over, is complete in the major markets, and that helped better performance for the company. Let's understand Europe. Europe did well due to favorable weather conditions. Growth was driven in the Europe by strong volumes in fungicide and biostimulant products. Despite pricing pressure, currency volatility, and a depressed market in Argentina, Latin America overall did slightly better. So, Argentina was very much under pressure. Brazil volume was led by Mancozeb as well as acephate based solo and mixture products. Argentina to start turning around in FY26 as guided by the management. Latin America is expected to do better in FY26. UPL had monetized its 12.5% stake in Advanta. We know Advanta is the subsidiary. So 12.5% stake in Advanta. Let's move into the next company, that is PI Industries. But for PI Industries, one thing is very important. We have to understand that PI Industries is unlike Rallis India, unlike UPL, although this company earns the larger part of their revenue from the export market. Its domestic revenue is 17%, just like UPL. UPL had 13%, it had 17%, and export was 83%. It is a Q3 FY25. Now the question is for PI Industries, how it is different from other traditional companies, even from UPL, who is similarly export focused. Now the question is the point is this company is very much different because it earns its revenue, most of the revenue, from the CRAMS business. That is the contract manufacturing business led by innovation, where this company is different. They are not selling any branded product. Rather, their focus is like supplying products to the big players, means they are basically B2B players. So they have like around 85% of their revenue comes from the top, I think, 12, 13 clients. So this is very important. That's why client concentration risk is obviously high, but despite that, just because of the beautiful business model, this company played the outperformer role in the entire sector for last few years. And that was very consistent performance, and most of the time it was against the sustainable non-sustainable performance in the sector. Either the rest of the players have had some downward performance or corrective performance or unsustainable spike in the in haphazard quarters. But PI Industries had a very consistent performance over the period of time just because of this beautiful and different business model. And CRAMS is a focus we know these days. Now, its success lies in how many of the new products, because it's innovation led. So, how many new products are going to be introduced? How many new products are in their pipeline of development in the R&D section? How many of them is getting commercialized? Those are very important, because whatever they are developing, that is with a target audience, target B2B player for whom this company manufactures products. Like once we will speak on PI Industries, then 3-4 items comes into play. First of all, the agrochemical export revenue. Like in FY25, agrochemical export revenue showed an improvement of 5%. This growth was mainly led by commercialization of new product. So one thing is coming in mind for UPL also. New product launches contributed around 2% of their top line. So 2% of the revenue of UPL came from new product launches. For this particular company, PI Industries, this 5% agrochemical segment growth was led by commercialization of the new product. PI Industries is transforming from a agrochemical company to a life sciences company, targeting growth opportunity in the custom synthesis and manufacturing sector. What I have told that it's a CRAMS company. So continuous, it's not only a normal CRAMS company, means it's not only supplying particular products offered to them, but they are developing products, and that developed product is basically product is developed for certain company, and that particular product has some years of uh, tie-up, some years of contract for supplying for to a certain company. So that is the model of PI Industries. So uh, now PI Industries is saying that there is 50% of new inquiries in their custom synthesis and manufacturing segment are now for non-agrochemical applications. So it clearly depicts that how they are gradually switching from their traditional agrochemical focus business towards other segment where pharmaceutical is going to play a key role. Along with that, they are also focusing into electronic, chemical, and biologicals as well. The shift reflects a strategic diversification beyond their traditional agrochemical space. In the pharmaceutical industry, outsourcing is aligned with high value complex segment and is driven by the need for end-to-end regulatory compliant regulatory compliance and scalability. So this is very important, that regulatory compliance means again you have to have that US FDA approval. So in the fourth quarter Q4 FY25, pharma business had a strong sequential growth of 33%, while the pharma business experienced development expenses and resulted in EBITDA loss of 180 to 190 crore for the full year. Now it's not a problem because it's not a short-sighted development for the company. They are saying about FY28 it may take time because innovation led business takes time. So it will take time, but as per the management's discussion, by FY25, hopefully the something positive will be visible from this particular segment. Now, biological segment is aiming for a target of 1000 to 1200 crore, which is 5x in next 5 years. So biological, what is biological? That is those natural products, which plays very crucial role in the for like in the crop nutrition or crop protection. So those biological products are going to be a very important segment going forward along with the pharma business. Now, regarding capex, company did around 800 crore capex in FY25, and management has guided similar level of capex in FY26. 800 to 900 crore, among 100 crore expected to be for the pharma business. UPL have captured that management has guided 4 to 8% revenue growth for UPL in FY26 and 10 to 14% EBITDA growth for the same FY26. For PI Industries, let me spell it that FY26 revenue is expected to be revenue growth is expected to be mid-single digit. Positive trends are expected in the second half of the financial year FY26. So first 2 quarters Q1 and Q2 is likely to be muted. Now with different like with other companies also, when you will have a look over there, you will find much difference is not there. Although like it will obviously it differs from company to company, but overall the structure is in average we can say is not very different. Overall FY26 outlook is not very different or whatever the last performance, apart from a few outliers which is not visible so far. So barring a few outlier, I'm considering there may be some outlier. So barring some outlier, much difference will not be visible. So this is the picture, and this is the outlook how FY26 is going to pan out. So that's it in today's video, and thanks for your valuable time, and don't forget to subscribe my channel for getting this type of analytical detailed video. Thank you so much. and